Hearty welcome to study circle meeting. Today's topic is transfer pricing issues in application of TNMM. To enlighten us on this topic, we invited an eminent advocate, CA Narendra J Jain is with us. Request R.M. Kama sir to escort him and welcome him to the floral bouquet. Please join me. Thank you, Kama sir. Friends, it is my pleasure to introduce CA Narendra Jain to this August gathering. A brilliant chartered accountant, a renowned advocate. Currently is practicing as advocate in TNMM Legal Chambers, Bangalore. He has experience in advising clients and handling tax litigation in transfer pricing, corporate tax and international taxation. In addition to his regular advocacy practice, he has authored a book, Analysis of Transfer Pricing Judgments, published by CCH, co-authored books on digital commerce and analysis of taxation aspects and emerging issues, published by IFA Bangalore subchapter. Made presentations at various seminars, workshops, etc. conducted by ICAI, other association and colleges. Faculty for CA final students at CAPS on direct taxes, international taxation and transfer pricing from 2004 to 2018. With this brief profile, I present CA Narendra Jain before you. Please join me to welcome him once again.
Respected seniors and dear friends, it's my privilege to be here today to share my thoughts on transfer pricing, especially in the application of method TNMM for computation of arm's length price. Before I start, just want to understand that how many of you are aware of the search that we do for transfer pricing, and one is the legal part of it, but how many of you have practical exposure in terms of actually doing transfer pricing study, so that it helps me to decide the level of detail we need to go for the purpose of this particular study circle. So given that for many of you may not have practical exposure on the transfer pricing study, we'll try to keep it at basic so that we can explain and understand the law, and then at a practical level, what are the things that if someone is doing a transfer pricing study under TNMM, then what are the things that he need to look at, what are the things that he need to be aware of, and when applying this method, what are the important aspects that one need to look at. As we all know, transfer pricing was introduced way back in 2002, and the objective of that was to provide the computation mechanism for related party transactions, what in transfer pricing we refer as associated enterprise. Post 92, as our Indian economy opened up, the multinationals who have set up business in India, or the Indian companies who are having businesses outside India. It's not just question of inbound, it's also question of outbound, because today we have examples of our own Tata buying global businesses or many other cases. So it's not just inbound transaction, even outbound transactions have become important, and keeping that objective in mind to ensure that the Indian tax base is protected and it is not that the profit is shifted outside India, the transfer pricing provisions were inserted. Section 92C of the Income Tax Act provides for computation of arm's length price. Prior to that, section 92 says any international transaction, income arising from international transaction, the income shall be computed having regard to the arm's length price. Now to compute that arm's length price, section 92C subsection 1 prescribes various methods. The difference here is you are having specific methods. If you look at the earlier anti-abuse provisions or anti-avoidance provisions like 40A2, that if you make a payment to relative, if it is unreasonable or excessive, then we are going to disallow that payment. But what is unreasonable or what is excessive was never defined. So it always, the assessing officer is going to say this is a figure which is unreasonable or excessive, this is a figure which should have been given, and the assessee is going to argue that the other way around. So in transfer pricing, because of global experiences, because the transfer pricing provisions were already there in many countries, because of those experiences, the specific provisions itself were inserted. So section 92C subsection 1 provides 5 methods, and 1 is a residual category where the board has power to prescribe a method. So first method we have CUP method, comparable uncontrolled price method. Second we have the resale price method, RPM what we call. Third we have CPM, cost plus method. Fourth method is profit split method, PSM. And fifth method is TNMM, which we will deal in greater detail today. So these are the 5 methods which have been prescribed under 92C. The computation methodology for each of these methods, that is what is the step that one should adopt to reach at the arm's length price, is prescribed in rule 10B1. So rule 10B1 gives a detailed description that if CUP is a method, what are the steps, step 1, step 2, step 3, you are going to adopt to reach at the arm's length price. The 5 methods, the first method CUP, comparable uncontrolled price method, depends on price. So there what we are testing is the price of a transaction. So if I purchase, say for example, pen from a related party, then what is the price with a similar pen you would have purchased from a third party. So comparison is between price. Then the next 2 methods, RPM and CPM, focus on gross profit. That means if I am purchasing something and selling, what is the gross profit earned in that transaction? Or similarly, if I am providing services, what is the cost plus margin earned in a transaction is tested. So there we are actually testing the gross profit. The next 2 method depends on net profit, PSM and TNMM. So likewise the methods have the different, they apply to different circumstances and different situations, and what we test under each of these methods is different. Coming to TNMM, why TNMM is important is, the other 4 methods, if you see the practical life situations or practical assessments or what TP studies most of you will find that 80 to 90% of cases the method that is applied is TNMM. There is a reason for that, but I will come to that. But that is the amount of cases in which you will find that TNMM is applied. 80 to 90% of cases you will find TNMM is applied. Therefore, it is very important for us to understand in what circumstances TNMM is applied, how the TNMM is applied, and what are the things that I should be aware of. So that covers most of the cases in which in case of the transfer pricing what method you need to use in most of the cases will be covered. The reason why TNMM is applied in most of the cases is, if you look at the CUP, there we are comparing the price of a transaction or a price of a product or a price of a service. It is very difficult to get this data that what is the price of a similar product. So if I buy a car engine from a related party, it is very difficult to get the data of a similar car engine in a market. So I really cannot compare the price in those cases. Also, price is very sensitive. If there is a small change, so if I am using a particular capacity car engine, if there is a slightly different category car engine, price will naturally be changed. So a branded product will be different from unbranded product. The price of a branded product will be different from an unbranded product. So therefore it becomes very difficult to get a price in a particular transaction. Therefore CUP is not that pervasive, or otherwise you say CUP is the best method. Price comparison is the best method. It is a direct method because you don't have any adjustments to do in most of the cases. But the difficulty is getting the data leads us to other method. If you see the next 2 methods, RPM and CPM, especially the CPM. Now CPM focuses on gross profit earned from rendering services or gross profit from manufacturing. So if I manufacture and sell to my associated enterprise, what is the gross profit that I will get? Now if you see the way our financial statements are built, you really don't get the gross profit data in most of the cases, right? Because if I am going the employee cost will include employee cost of factory people, will include sales and admin people, will include the marketing guys. So you don't have the breakup of what is the cost of production. Similarly will be with respect to rent or other expenses, that what is factory rent vis-a-vis what is office rent, data may not available. So you cannot really find out gross profit from the financial statements in a very easy manner. If you come to RPM, which is applied in trading transactions, that means if I purchase from my E and sell to third parties, that is the resale price method, as the name itself suggests, resale. That means I purchase and sell. So in those cases, the gross profit can still be found out in cases the purchase, sales, opening, closing stock details are readily available in the financial statements. But CPM is very difficult to apply. PSM is applicable in very limited situations. The rule 10b(1d) itself provides that you can apply the profit split method only in cases where it involves transfer of intangibles or there is a completely integrated or interrelated transactions. In those limited circumstances, PSM can be applied. So by default, what has happened is TNMM becomes a method of choice, because in TNMM we compare the net margin which is available from the financial statements. So if I take a financial statement, I'll be able to find out what is the net margin earned by the company. It is something which we all easily understand and even the department easily understands. That is the reason why the TNMM has been a method of default choice in many and many cases. So now let's go to the rule. What does rule provide? And then we'll try to understand in various nuances of this particular method. So for application of rule, application of computation of ALP under TNMM, the rule says the net profit earned realized by the enterprise from an international transaction or specific domestic transaction. The computation methodology for international transaction and specific domestic transaction is same. There is no difference. No doubt after the amendment of 2016, specific domestic transactions are not that relevant except in case of tax holiday undertakings. But even otherwise, those transactions still remain. 92BA still remains in the statute. So first step here is find out what is the net profit realized by the enterprise from an international transaction entered with an associated enterprise is computed in relation to costs incurred, sales affected, assets employed or to be employed by the enterprise having regard to any other relevant base. So this is the first step. Now what does this say? That you will compute the net margin that an enterprise earns from its international transaction. So what is the net profit earned from the international transaction is the first step I need to understand here. We'll take all this in greater detail as we go further and what are the issues that arise because of each of this. But let us understand this. Second, this net profit can be computed having regard to various bases. It could be net profit in relation to costs, that means the cost what I have incurred for rendering those services or selling those goods, or it could be in relation to sales affected. So it could be net profit divided by sales. In relation to means what is the ratio that we can use. So I can use net profit by operating cost, that's the cost what has been stated there. Net profit by sales, what is another ratio which has been stated there. It can be in relation to assets employed or it could be any other relevant base. Why different ratios have been given? That is one thing that we have to keep it in mind. As we go further, we come to something called as profit level indicator. There we will realize why this particular phrases have been used. Why different costs, sales, assets have been used. That is the first thing. I will explain this as we go further. Then second step, net profit margin realized by enterprise or by unrelated enterprise from comparable uncontrolled transaction or number of such transaction is computed having regard to same base. So the last limb of clause 2 says having regard to same base. That means if I have taken net profit to cost in clause 1, then I have to take net profit to cost in clause 2 also. That's an easy way to understand it. What does clause 2 says? That you have now found out what is your net profit earned from international transaction, realized from international transaction. Then find out net profit realized in comparable transaction. So that means I need to find out what are the comparable transactions. Suppose, to give again a simple example, if I am rendering software services to my associated enterprise outside India, then I will find out another company which is also rendering software services to third parties. So what is net profit realized by me? I will compare that net profit realized by the comparable. So that is what we call as comparable uncontrolled transaction. In a short it is called as CUT, C-U-T, CUT, or number of such transaction. So having regard to same base. This is step 2 in computation of TNMM. The step 3 in computation of TNMM is that net profit realized in subclause 2, that means the net profit realized in CUT, comparable transaction, arising in comparable uncontrolled transaction is adjusted to take into account differences, if any, between international transaction and the comparable uncontrolled transaction, or between enterprise entering into such transaction which could materially affect the NP, net profit, in the open market. What this clause 3 provides is that now I have found out net profit earned in international transaction in clause 1. I have found out net profit earned in the comparable transactions. Now, but there could be difference between transaction A and transaction B. There could be difference between transaction A and transaction B. Say for example, in transaction A with my related party, I have got an advance. Whereas in transaction B, there is no advance. So there is a difference. Naturally, the normal understanding is any of this difference will factor in the price. So if I have to give warranty, I will factor in the price. Say for example, if I sell a laptop with warranty and without warranty, naturally the rates are different, right? So if you increase any function, if you increase any risk in a particular transaction or an asset in a particular transaction, the rate is going to be different. So there could be difference. Now they say the differences could be of two types. One difference could be in the transaction what has been undertaken, that is why we call difference in international transaction and comparable uncontrolled transaction, or between the enterprises entering into such transaction. So these are phrases which are used, what we generally refer as transaction level differences or enterprise level differences in the TP terminology. That there is a difference in the transaction itself. So transaction differences, if I do a sale in a CIF versus a sale in FOB, it's a transaction level differences, because the transaction itself has certain distinguishing factors, right? But if the second kind of difference is the enterprise which is undertaking the transaction. So I may do an FIB sale, the other company also may be doing an FOB sales, but I am a small company and that is a very large company. So the enterprise which is entering into a transaction is a different enterprise. So that is enterprise level differences. So the sub-rule 3 here, 10B 1E clause 3 provides that you will make an adjustment for transaction level differences or enterprise level differences to the net margin computed in clause 2. That is the net margin earned in comparable uncontrolled transactions. Clear? Up to here clear? If you have any questions, or we can make it interactive, if you have any question you can just bounce it up, we'll take it up. Then the clause 4 says the net margin realized by the enterprise in clause 1 is established to be same as net profit realized in clause 3. So the adjusted net margin that we get in clause 3, you compare that with the margin that is there in clause 1 and then test it whether it is at arm's length. Then clause 5 says that it will be taken to arrive at arm's length. Now this is what basically the rule says. This is what the rule says. Now the rule provides these steps for us to compute the arm's length price. Compute the arm's length price. As I stated in the beginning that TNMM is a method which is used very extensively, and you will find in 80 to 90% of cases TNMM is used for the reason I have already explained. So one of the strengths of TNMM, there are various strengths and weaknesses of TNMM. One of the strengths is the TNMM is tolerant to certain differences, especially sometimes the accounting differences. For example, if you take warranty. So if I made a sales with warranty and without warranty, naturally if I compare the price, is it comparable? No, right? So if I take a simple example, say 100 rupees is the sale price of a product and 2 rupees is the warranty cost. So when I am making a sale, naturally I am going to charge 102 rupees for this product because I want to recover this 2 rupees somewhere in terms of my cost. That 2% of warranty cost I would have designed based on my historical data, that yes, for last 5 years I have done warranty services and this is the cost which I incurred for doing a particular warranty services. In accounts, what we are going to do, we are going to book the sales as 102 and make a provision of 2 rupees in my as a debit to P&L account, correct? Okay. Now just look at this. If I take the cup method, the price is different with warranty, without warranty. I cannot directly compare it unless I make an adjustment for warranty. Can I compare a gross profit? Again no, because sales is above the line, provision for warranty is below the line. So if I use a resale price method or a cost plus method, the gross profit will be still higher by 2, right? But when we come to net profit ratio will still be very similar. The net profit, that is ultimate absolute figure that is there, is very similar, because the sale price which is excess by 2 rupees is nullified by 2 rupees of provision for warranty. So these are accounting issues that were there. So some way the TNMM tries to adjust these differences in an account itself. There are other differences which will come to that. But that is one of the strengths of TNMM, where when we are using this method, there is that benefit available. If we take this forward, if I go back to clause 1, these 2 slides will keep referring throughout the session. If you see the step 1, what it says, you can do it based on cost, you can do it based on sales, right? You may have different kind of related party transaction. Some company may be selling the manufactured goods to the related party, associated enterprise. Some company may be rendering services to associated enterprise. Some company may be purchasing goods and doing a resale in the local market. Or some company may be purchasing raw material, converting them into finished goods and selling it to local market. Can I apply TNMM to all the transactions, all the different transactions? Or TNMM will be restricted to only some kind of transaction. So as I said in the beginning, PSM is restrictive. You can apply that only to either the transaction which are having transfer of unique intangibles, or where there are interrelated transactions, integrated transactions. Similarly, if you take RPM, resale price method, that is applicable only where you purchase from associated enterprise and do a resale, because the name itself is resale. Okay. Now when come to TNMM, can I apply universally to both debit and credit side of transaction? The clause 1 gives an indication for this, because clause 1 gives us different bases. You can take sales as a base, cost as a base, you can take assets as a base, or any other relevant base. How this is important, as we proceed further into profit level indicator, I will explain it further why this becomes important. But the point that I want to make is, one of the strengths of TNMM is you can possibly apply this to both debit side and credit side of transaction, debit side of the P&L and credit side P&L, or different kind of transactions that TNMM may be made. To that extent, TNMM is universal in nature. The cup is the most universal method, because every transaction will naturally have a price. There is no transaction which will be without a price. So I can apply cup to any kind of transactions. I cannot apply TNMM to all kind of transaction. For example, if I give a loan to my associated enterprise and charge an interest, can I apply TNMM? Can I apply net profit? Is there a concept of net profit from that interest? Or I take a loan and pay interest, then can I apply TNMM? Difficult, because we are looking at net margin, we are not looking at price. But in financial transactions, we can always apply cup method. So when we select a method, these are the things that we have to be aware of. We have to be aware of that which transaction, what kind of method I can use. Generally TNMM is universal, but there could be categories of transaction where I cannot apply this. So if there is a transfer of intangible, I cannot apply TNMM, because there is a concept of net profit from that transfer of unique intangible. Net profit is the accounting net profit which generally understand from our financial statements. So these are positive sides of TNMM, but there are negative sides of TNMM also. The net profit many times may be affected by external factors which have no relationship with associated enterprise. Suppose there is a labor strike, because of which I am not able to manufacture. My sales is down, naturally my net profit is down. Now this has nothing to do with my related party, it is an external factor. But when you look at TNMM, it gets impacted. The net profit gets impacted because of these external factors. So these net factors, these external factors we have to do an adjustment. How we do an adjustment is a different part of it. So that way, the net profit is highly influenced by external factors that may not be relevant part when we look at the price or a gross profit in many of the cases. So they are sort of a disadvantage of TNMM, which we have to live with it. Before proceeding further in actual application of TNMM, we also need to understand Rule 10b sub Rule 2. Rule 10b sub Rule 2 lays down what are the characteristics for selection of comparables. How do you select a comparable? That is laid down in sub Rule 2. And these are the features that we need to see before deciding a comparable. Sub Rule 2, sub Rule 3 are two relevant rules before we proceed into actual application of the TNMM. Now, so comparability. So comparability, what we say, is the heart of transfer pricing. How do you decide the comparability? That is the crux of transfer pricing. If you are able to understand how I am going to decide comparability and how I compute ALP, then in transfer pricing is not a rocket science. Anyone can do it. It's pretty simple. Now, what are these characteristics, specific characteristics of a transaction? So you need to see quality is a specific characteristics, brand is a specific characteristics, product profile, functional profile, what functions a person performs. If it is a service industry, what functions a person performs. Manufacturing industry, what is the functions that you are performing. Are you just doing an assembly job? Are you just doing a job work? Or are you doing a full-fledged manufacturing? So it's a functional profile. So that is a specific characteristics of a transaction. FAR analysis. This is relevant for all the methods. These characteristics or comparability parameters are relevant for all the methods. It's not just for TNMM, but applicable for all the methods. FAR analysis, function, asset, risk analysis. Function, asset, risk analysis. The rule 10D, right, with section 92D, specifically provides that every transaction you need to have a FAR analysis. And this is again one of the most important aspects of transfer pricing, that how do you do a FAR analysis. Just give a brief snapshot on this so that we can proceed. So every transaction, or what we say the profitability in every business, is function of these three things. Function, asset, risk. So if I'm a commission agent, I'm just doing a marketing, I'll get a particular, say, commission rate. But if I increase my risk, I become a delegatory agent who also takes a risk of bad debt. Naturally, I will expect more commission. Suppose I go further, I become a distributor, take inventory risk also. I will naturally expect more commission than the normal commission agent. So if my function, asset and risk deployment increases or decreases, or it is different, then my return will naturally differ, or it has to change according to the functional profile. So when I am doing the comparability analysis, suppose I am saying A company is comparable to B company. The question is whether A company's FAR, function, asset, risk, matches with B company's FAR. So that is an analysis that we need to do for the comparability analysis. Terms and conditions of contract. So when you are having a contract, like it is a FOB, CIF, cost plus model, how much warranty is given, on how many months I will get the money. All these are contractual terms that may be listed in a contract, which we need to be aware of. Fourth and fifth are market conditions. That means in a market which company operates, what are the geographic circumstances? Can I compare a company in India with company in China? May be difficult. Cost of capital may be different. Cost of labor may be different. Can I compare sales made to African continent to sales made to US? May be different. Currency is different. Then other economic factors may be different. So what is the level of market, geographical market? Those things have to be seen. Now we'll just pause here. So these are the comparability parameters. The question first we need to understand here is that in a TNMM, what are the relevance of these comparability parameters and how do we apply this? Can we reduce these comparability parameters? Can we ignore these comparability parameters under TNMM? Rule 10b2 provides these comparability parameters. It provides this for all the methods. But with each of the method, comparability parameter change. This is one thing which we have to keep it in mind. For example, if I take a cup method, I am comparing prices. Can I compare a price of a toaster with a blender? Naturally no. Toaster and blender are two diverse products. I cannot compare the price of a 40-inch TV with a 55-inch TV also, right? Because they are two different products. But can I compare the net profit earned from sale of toasters to net profit earned from sale of blenders? Can I say the functions involved, assets deployed, the kind of sales effort that I'll have to make to sell a toaster and sell a blender is very similar? So my function is same, my FAR is same, but product is different, right? Agree? So under TNMM, one of the important aspects that we have to keep it in mind is, if you see all the methods, right from cup to TNMM, the cup requires highest level of product comparability. A slightest change, the price will change. the price is most sensitive to a smallest change. Even if the packing changes, a 12-piece product, a 12-item product, the price may be different, and when you take a single piece, the price may be different, because even the packing may have an impact on the pricing. The transportation, logistics may have impact on pricing, foreign currency may have impact on pricing. So many diverse factors could be there which have an impact on pricing. But when it comes to TNMM, some of these gets nullified. So if my sale price is less because I have packed and bundled 12 items, but my packing cost is also less. To that extent, there is a nullification of that. So what we say that under TNMM, product comparability is important, but more important is the functional comparability. That means if I am into retail sale of toaster, I should compare with another retailer who is in a sale of maybe toaster or maybe blenders, not necessarily only the toasters. So this is an important aspect that has to be kept in mind under TNMM, that you can deviate from exact product comparability under TNMM, but you will not be able to do that when you look at the cup method. No doubt, you cannot take two diverse products. If I take toaster, I cannot compare with the sale price of a net margin from sale of soaps. They are two different industry. The question is, to sell these two products, can I say the FAR of selling a toaster and FAR of selling a blender is very similar? If it is a similar, then I can take that also as a comparability. So the takeaway for us from here is from rule 10b2 and is that in case of TNMM, there is a possibility to adopt broader product comparability, which could be same industry or a same or substitutable products or similar function analysis. Like if you are saying toaster and blender, we can say kitchen items, or we can say into a similar FMCG product category, or we can say similar white goods. So when you are having different products that you are dealing with it in terms of transfer pricing study, you need to try to broaden the transfer pricing study when the method adopted is TNMM, but when the method adopted is something else, then you need to have a stricter product comparability. Right? Any questions here? Okay. Now let's move to 10b3. This is again an important rule, very simple that way. It says that what we need to compare, what is the threshold of comparison. So you need to check, suppose now I am having two comparisons. Mine is company A, that is the related party for whom I am applying the transfer pricing, and there is a company B. So I am rendering software services. So I am trying to compare net margin earned from software services rendered to associated enterprise with the net margin earned by company B for rendering similar software services. Let's take this example. Right? The question is, are there any differences between company A and company B, either transaction level or enterprise level, which materially affect price, cost or profit arising from such transaction? If the answer is no, then they are comparable. So are there any differences which impact price, cost or profit? So if there are normal small differences, may not matter. But if there are differences which impact price, cost or profit, if there is that kind of a difference, in those cases you need to decide if there is a difference. If there is no difference, it becomes comparable. If there is a difference, then we need to go to the step 2. The material differences, whether in reasonable, accurate adjustment can be made to those material differences and whether that difference can be eliminated. So step 2 would say, first is we identify comparables, then we will see whether there are any differences. Then if there are no differences, it is anyway straight away comparable. But if there is a difference, then we next ask a question, is there a way we can make a reasonable, accurate adjustment for that difference? And if the answer is yes, then that can be taken as a comparable. If the answer is no, then you need to reject that comparable. So I'll give an example. Suppose I made a sales of the laptop to my associated enterprise, I manufactured and sold. I have also sold the laptops to third parties. Now my sales to associated enterprises FOB, free on board. My sales to third parties is CIF. Now is there a difference? First question, is the laptops comparable? Let's assume it is a similar model. Yes, the laptops are comparable. Is there a difference? What is the difference? FOB versus CIF. So that means my sale to third parties is higher because a component of insurance is right in that. If I do direct comparison, then there will be an adjustment, because that will mean that you have sold related party at a lesser price and inflate your profit. That adjustment is being made by the officer. Will say you have sold at less price, you should have sold at more price. But this is a difference that has to be looked at. So is this difference which impacts price, cost of profit? Yes, this is the difference which impacts the price. Next, can I make an adjustment to bring that CIF to FOB? So can I reduce if I have the data that this is the insurance cost, this is the freight cost in this particular transaction. So I am saying, okay, 110 is what I have charged, 5 rupees is insurance and freight, I make it 105. And my FOB price is say 103. So then I compare 103 versus 105. So these are the important aspect that we need to keep it in mind. That is there a difference? Yes or no? If there is a difference, then can the adjustment be reasonably accurate adjustment? We cannot make an ad hoc adjustment. You'll have to be sure that it's a reasonably accurate and we have sufficient data, or the assumption that we made is sufficient. For example, in FOB CIF, we may make an assumption that insurance is always 1% of freight. That is the industry standard. So that assumption, the question is that assumption reasonable, having regard to the industry standards? Yes, then you can make an assumption also. You need not have exact data that what is the freight charged in that particular case or what is the insurance charged in that particular case, but it could be an assumption which is having a reasonable standard or a basis. Next point I have written here is internal comparables versus the external comparable. This is one important aspect we need to look at it. What do you mean by internal comparable? I give an example that I am manufacturing laptops and I am selling it to the third parties, and I am also selling to the related parties. So here, when one party to the transaction itself is doing a third party transaction, when I am doing transaction with my related party and I am doing transaction with third parties, it's internally there is a data available. Second level of comparison will be that I am selling to related party. I found out one company XYZ Limited which sells to third parties and they are not related parties. XYZ and say ABC are not related. So they do a transaction. So that becomes an external comparable. That becomes an external. Question is, can I adopt internal comparable or I should adopt external comparable? Does the law permit me to adopt an internal comparable? And in a situation where I have both internal as well as external, what should be done? Now come back to the sub-rule 2, clause 2 rather. The net margin realized by the enterprise or by an unrelated enterprise, by the enterprise or by an unrelated enterprise from a comparable uncontrolled transaction. So what does this say? Net profit earned by an enterprise from a comparable uncontrolled transaction, net profit realized by an unrelated enterprise from a comparable uncontrolled transaction. So here itself, if you see, the indication from the rule is very clear. Here itself, if you see, the indication from the rule is very clear that you can use internal comparable if you see the first line, net profit realized by an enterprise from an uncontrolled transaction, or net profit realized by an unrelated party from an uncontrolled transaction. Ideally, as per the judicial precedent, as per the principles of transfer pricing, if you have an internal comparable, that is the best comparison. That is the best comparison. You have to give precedence to internal comparables vis-a-vis the external comparables. The internal comparable will always be more accurate and more reliable than external comparables. Yeah.
In this situation, say my majority of my sales are to my parent company outside India, and because I have a choice of taking an internal comparable or an external comparable, is it profitable for me to at least sell say 10% of my goods or services to another person at a lower price which matches the price I want to sell to my this thing, and use that as a comparable?
So now he is saying that if there is no comparable, can I create a comparable?
So 10% of my sales.
See, the law is very, the law does not say what should be the threshold of whether it should be 10% or 20%. It just says whether there is an internal comparable available, adopted. The legal principle that if there is an internal comparable, it is always superior to external comparable. That is settled. There is no dispute on that. Only question that will arise is because of higher volume of sales, is there any volume discount that is to be given? So at a practical level or a factual level, you will have to demonstrate that FAR in an external comparable will be similar to FAR in an internal comparable in terms of all the 5 parameters what we discussed. So if I am able to demonstrate that, it could be even 10% or 15% or 20%, I do not see any threshold and do not see any problem. But if it is very low, that means 99% is to A and only one-off transaction is to non-A, there may be challenges. It will be difficult to pass the judicial threshold or judicial scrutiny to say that it is a comparable. But if there is substantial sales, maybe on 10%, then I think it's a good reason to say that I have an internal comparable. Coming to the price, that is market driven. It is your choice that you want to sell it at a lower price or higher price to third parties. And if you are able to demonstrate that my sale to A is higher and sales to third parties is lesser, and lesser third parties are independent parties, which I am able to demonstrate, this should be taken at arm's length. Okay. Then when we come to these methods, another important aspect that arises is the data that we have to take. So I have done transaction in say financial year 18-19. What should be the data of the comparable? Should that be of that 18-19 only, or it can be of the preceding years also? What should be the level of data or timing of data rather when I am doing the comparison? Rule 10b-5. Earlier there used to be rule 10b-4, which mandated that you will take only current year data and you can go 2 years prior data, or you can adopt 2 year prior data if you demonstrate that 2 year prior data has influence on the price of the international transaction. That rules up, that 10b-4 is no more applicable. Now what is applicable is 10b-5. 10b-5 gives two thresholds. First, it is applicable to RPM, CPM, TNMM. So if you have a cup method or PSM, you cannot go for early year data. You will have to adopt the current year data, right? And when you are looking at data also, current year data also, especially if you are using the price as a comparison basis, you will have to be further careful. For example, commodity prices, they may fluctuate on a very regular basis, daily basis, gold, oil and various other commodities. So I cannot maybe compare price in an April to a June. So that is another aspect. When you are actually looking at the price comparison, that becomes very relevant, that even if there is a wide fluctuation, if the prices of that particular commodity there is a wide fluctuation, you need to try and get as close to the transaction date rather than adopting say different quarter or a different month. Coming to TNMM. In TNMM, you will adopt by default, the preferences for current year data. The law prescribes that we will first look at current year data. So if I do a transaction in say, let's say financial year 18-19, and I am looking at comparables, my first choice of a method the data, timing of data is that comparable data should be of the financial year 18-19. That's a step 1 that we have to keep it in mind. Second, the rule says, 10b-5 says that in case the current year data is not available at the time of furnishing the return of income, then the assessee has a choice of adopting preceding financial year data. So current year CY, 18-19 is the current year CY data. If by a reason that, now why this happens is, for me the comparable data to be available, we have used various databases. You must have heard databases like Probase, Capitaline, ASTP, which house data of 40 to 50,000 companies and give you the data in terms of this. They pull out this data from various filings that the companies do, stock market filings, ROC filings. They take the data from that, they summarize it and put it in this. Now at the time of filing the return of income in November, not necessary that all of them would have filed their ROC returns and that data becomes available. So this was one big challenge in the initial year of TP, that we are not able to find current year data and law expects you to do the current year data. So how do I do it? Later on they realized that this is becoming very difficult, and that is why for transfer pricing cases they extended the time by 2 months. So normal tax audit is September, but for transfer pricing they made it November. Because the expectation was that by November at least some data will be available in public domain or at least in the databases. This also is very difficult. At a practical level, if you see, getting this data becomes very difficult. So now what, in 2014 when the amendments were made and these difficulties were brought to the notice of the relevant authorities, they said fine, at the time of transfer pricing study, if you are not having current year data, you can go to one preceding year, P by 1. We will refer it as P by 1. That means I am going to one preceding year. So you adopt either current year data or one preceding year data. Clear? Now the challenge is the transfer pricing officer, the TPO, does this study after 2 years or 2.5 years, and when he is doing the study, the current year data may be available in the database. So proviso to 10b5 says that if the current year data becomes available at the time of assessment proceedings, then there is no bar that the authorities do have a power to adopt the current year data. So when assessee does a study, assessee will look by default for current year data. If current year is not available, he will go to P by 1. But when the officer does a study and he has the current year data in all probability, because 2 years would have lapsed and current year would have become available, then no doubt at that time when I did the study, current year was not available, but when the assessing officer did the study, current year is available, he can adopt that current year data very specifically because of 10b5. Now this is a problem area. To that extent, there is no level playing field between the assessee and the TPO. TPO gets an opportunity after 2 years, and there will always be possibility that when I did the study, that particular company with a low margin was there and I took it as a comparable based on previous year P by 1 data or for some other reason, and when he does study, he finds out companies based on current year data where the margin is higher, so therefore what margin he gets might be higher than what margin I got. So this is the challenge with the with the 10b5, but the rule specifically recognizes that the assessing officer has an power to adopt the current year data at the time of the assessment proceedings. Possibly someday this level playing field which is not there with the assessing may be challenged in the courts, but as of now this is what we need to keep it in mind. Then coming to actual computation of numbers, which is provided in Rule 10CA. Rule 10CA. Now another point we have to keep it in mind is this Rule 10CA is applicable only when you get more than one comparable. So if you have one comparable, Rule 10CA is not applicable. Suppose I am adopted TNMM as a method, I do a search on database. Again I will take the example of software company. I am rendering software services or I am rendering call center services. In the database I do a scan, I find out 10 companies which are doing call center services. Then no problem, I can apply this rule. But if I find only one company which is doing call center services, then I cannot apply this rule. I cannot do the computation as per Rule 10CA. I go back to the main section 92C itself to do the computation. Generally, as an experience, we will find that in most of the cases we are able to find more than one comparables. So Rule 10CA will be applicable. Now what Rule 10CA provides? Rule 10CA, as I already explained to Rule 10b5. Rule 10b5 says current year data. If current year is not applicable, you can adopt previous year P by 1 data, right? One preceding year data. Now the rule says you will compute the weighted average margin of 3 years. Weighted average margin of 3 years. Prior to 2014, we were only looking at the current year data for margin computation. That means what is the margin earned by company B. So I was saying company A is comparable to company B. So if I look at company B, what is the margin that I need to look at? So by doing the computation of margin of company B, I will take financial year 18-19. And the rule says you have to take weighted average of 3 years. Now keep it in mind that adopting weighted average margin for 3 years is mandatory. You don't have a choice. You cannot say I will take only single year data. You will have to take 3 year weighted average margin. That means if I take March 19, I will have to take March 19, I will have to take March 18, I will have to take March 17. Now these 3 years I will have to compute the weighted average margin. This is what the rule mandates. Now I go back to Rule 10b5. So if I am having current year data, that is March 19 data, I adopt March 19, March 18 and March 17, right? Now if at the time of TP study I didn't have March 19, I had only March 18, then how many years back you will go? Can I go for March 17, March 16? Or you will only take March 17? You will only take March 17. So if you have current year data, you will take 3 years weighted average. But you have preceding year 1 data, then you will only take 2 years weighted average. That is what the Rule 10CA provides. Another point that we should note here is that while I am adopting, if I have taken a company as a comparable based on March 19 data, and I have to compute the weighted average of March 18, March 17. But it is not comparable in March 18 for some reason. Say for example, I am doing export services. So comparable also should be doing export services, right? If I am doing export services, can I take a company which does domestic services? Naturally, geographical market is different. So company A, which I have taken as company B, which I have taken as comparable, in March 19 is having export services. But in March 18 does not have export services, has majority domestic services. We generally apply 75% rule that if it crosses 75% threshold of export, then it should be taken as a comparable. So let's assume that 75% rule is adopted in your TP study, and when you do the analysis, in March 19 company B has 80% export, but in March 18 it has 70% export, and in March 16 or March 17 rather, 19, 18 and 17 it has 60% export, so less than our 75% threshold. Should I still compute weighted average margin of all the 3 years? I should have take only March 19. Yeah. You'll have to restrict yourself only to March 19. The reason is the rule 10CA provides that you will apply the comparability parameters which you have adopted in March 19 to the other years also. So if I adopt 75% export filter in March 19, I need to adopt the same in March 18 and March 17 also. So I will do the comparability based on March 19. But while computing the margin, I need to take 3-year data. And when I am taking the 3-year data, I need to ensure that for all the 3 years it is comparable to me, not just 1 year. Okay? This is an important point. So, just to summarize this, first I will look at current year data. I will see if current year data I am comparable or not. If I am not comparable based on current year data, that company is out. You don't take it as a comparable. Right? In our example, if that B Limited in March 19 is say 60% export and our threshold is 75%, it is out. I need not even bother about the preceding years. Okay? But the current year is 80%. It is crossing the 75% threshold. Then March 18 I will go and do the computation. I will check whether it is into same call center business, whether it is having export, all other parameters what I am applying I will apply to March 18 and March 17 independently. And then I will test whether it is a comparable or not. If it is a comparable, then I compute the weighted average margin for all the 3 years. Clear? Any doubts at this stage? Okay. Now, what the rule further says is, if you have 6 comparables, 6 or more, then you will adopt the interquartile range. That is the median concept of, we go back to our statistics day, median concept of computation of arm's length price. If the comparables are less than 6, say for example 5, then you take the average. So the arm's length price will be different in both the cases. For the same set, if you apply a mean, and for the same set if you apply a median, naturally the price will be different. As we all understand, median is the middle value in the, when we arrange the set, data set in an ascending order, the middle value is the median. That is so if you have 11 values, the 6th value in all probability, or rather the 6th value will be the median. But when I am looking at average, I am going to total all the 11 values and then divide by 11 and get the average. So that is the different way of computing this thing. One more point before we proceed is, the weighted average when you are calculating, what weights you are going to take. So if it is RPM, you will take sales as a weight. If you CPM, you will take cost as a weight. So that has to be kept in mind. The rule itself provides a simple example. Rule 10CA, if you go to 10CA, there is a big 2-3 tables on how to calculate the weights, weighted average margin. It's pretty simple. You add all the sales, add all the cost, and then do get the profit, profit by sales, profit by cost, depending on what is the method. So that has to be done. So rule prescribes that, you can just follow that, how to compute median and other things have there. In case you have adopted median under TNMM, if you have adopted TNMM because you have 6 or more comparables, then the interquartile range is the arm's length range is 35th percentile to 65th percentile. That means if there is a value of 10, it will be 4th value to, if you arrange 10 comparables in ascending order, the 35th percentile, you will leave 3.5 above, so you get the 4th value, and you will leave 6.5 below, you will get the 7th value. So 4th value to 7th value becomes the range. and that is your transaction value should be in that particular range. What I mean is, suppose I have rendered service, or my net profit under TNMM is 15%. Okay. Now there are 10 comparables. Now 10 comparables you arrange in the ascending order. So first one may be say 2%, then it may be 4%, it may be 10%, it may be 11, it may be 13, it may be 16. So you have arranged that in ascending order. The 15% what is your margin should be within 35th percentile and 65th percentile of that data set. Then you are at arm's length. If it is less than 35th percentile, then you are not at arm's length and the adjustment will have to be made. So for example, assume you are at cost plus 10%, you earn 10% margin on cost, and the comparables 35th percentile after arranging in the ascending order is 12%. That means you are earned lesser profit compared to comparables, which is not a good indication. If you have earned lesser than 35th percentile, the transfer pricing adjustment will be difference between median minus your margin. So if the median is say 20% and your margin is 10%, and 35th percentile is 13% because you are outside the 35th percentile, then 20 minus 10, 10% is what you are going to add to your transaction value. So if you have 100 crores transaction, 10% of that 100 crores will be 10 crores will be added to your profit and to your total income. So this is how the TNMM will work. So you need to compute 35th to 65th percentile, see whether your margin is within that range. If it is outside that range, the adjustment will be between median and your margin. If it is mean, the adjustment will be mean and your margin. Yeah, and in case of mean, the range is 3%.
Why is there a higher percentage of 65? If my price is more than 65%,
you may have both ends of transaction, purchase and sales.
Oh, purchase. Okay.
So other side will work for the purchases. Yeah. Now under TNMM, one of the important aspects is how do you select an profit level indicator. That means we discussed in the beginning various ratios, profit to cost, profit to sales, assets employed, right? What is the basis of selecting a particular ratio, and what are the different kinds of ratios we can use, and how do you compute the profit? Because the first point which we discussed is, in the rule is net profit realized by an enterprise from an international transaction having in relation to cost incurred, sales affected, assets employed. So we said net profit realized. So the numerator is net profit, denominator could be cost incurred, sales affected, assets employed. Right? How do you decide this numerator and denominator? Because the net profit also may be profit before interest or tax, maybe before tax, before depreciation. There could be so many variables that could be available. So we call this as, in the transfer pricing language, this is called as profit level indicator. So what is the indicator, profit level indicator? One fundamental thing that you have to keep it in mind is the denominator in the ratio. The denominator in the ratio should be independent. That means, suppose I render services to my associated enterprise. Let's take a simple example. 100 rupees is the cost and 110 is the sale price. Net profit is 10. Now 110 is the sale price to my related party, right? So if I take 10 by 110, my denominator 110 is to related party. The whole problem is this 110 is correct or not, we have to decide, right? What we have to decide, that the sale price to your related party, should it be 110 or should it be 120? That is the dispute, correct? So if I take that as a denominator, naturally the net profit ratio itself is wrong. Because tomorrow if you want to change this 110 to 120, the net profit will again change, right? So one of the first principles while selecting a profit level indicator is the denominator should have uncontrolled transaction. That means it should not have controlled transaction as a part of the denominator. So if I do a sales, I will adopt cost as a denominator. If I have purchases from related parties, which I have converted say into finished goods, then I will end up those finished goods I have sold to third parties. Say for example, car manufacturer will get engine transmission from related party and sell the car to the third parties. Now here the sales is untainted, it is with third parties. So I will take profit level indicator of net profit divided by sales. So That is one principle that you have to keep it in mind. Second principle that you have to keep it in mind is the TNMM, as I said in the beginning, provides flexibility. Cost, sales, asset employed, it could be capital deployed, depending on what is your driver in a business. So if it is a banking company, capital employed may be the most important thing. If it is an asset intensive infrastructure activity or something else, that asset deployed may be most important. So you have a choice to take the denominator depending on what is your FAR, function asset interest. That is the choice which you are having. So you need to look at each case. In most of the cases, either profit or cost will be the most important part, but there could be cases that you may get there you want to adopt a different profit level indicator. In fact, if you look at Indian rules, they are restricting themselves to these financial parameters. If you go back here, it says cost, sales affected, asset employed, or to be employed, or having regard to any other relevant base. Now the question is, any other relevant base? Can I take employee as a base? Can I take retail? If it's a retail business, can I take floor size as a base? What is the profit per feet or meter they measure in the retail industry? Can I take that as a base? Indian law, more if you look at apply assuming generous and read any other relevant base along with other thing, it will possibly give an indication that you can only take the financial indicators. But OECD commentary and other also refer to employee numbers, refer to floor size and various other parameters. So again, these have to be tested. We do not have judicial precedent on this. So we need to test this and see whether you can employ something else also in a facts of a particular case. Right? So that is one point. The denominator should be uncontrolled. Second is the data, whether it is numerator or denominator, what you are having, the net profit what you are having should be reliable. The computation what you are giving should be reliable. Suppose I have a comparable which I have taken, B Limited. Now if the annual report of that company is not available, I cannot just compute the net margin from director's report. You need to have complete data, because you need to take only operating expenses or operating revenue as a part of the profit level indicator. For example, if there are one-time termination cost, startup cost, abnormal expenses, one-time write-offs, amortizations, so those cannot be part of net profit realized. We are looking at net profit realized from the international transaction. That means we are looking at regular activities, not non-recurring or abnormal or extraordinary items. Those non-recurring items, abnormal items or extraordinary items should be excluded while calculating the profit level indicator. So if I have one-time huge write-off on my investments made into subsidiary outside India, when I compute the net profit realized, it has nothing to do with international transaction. I need to exclude that. Similarly, interest cost, most of the time you have to exclude that. So these items in your P&L account, you need to scan and see what are relevant items, what are the operating items that I need to take, and what are the items that have a link with the international transaction. That has to be seen in this case. Give one more example here. For example, let's take a case that I am rendering software services to my related party and I render call center services to third party. Now when I calculate net profit realized, what will be my net profit? Should I take entity level net profits or should I draw the segments? We'll have to draw the segments, right? Because net profit realized from the international transaction. It could be further example. Suppose I render software services to related party and software services to third parties. But that software service itself may have two segments, the AE transaction and non-AE transaction. So you need to further break it up. So like this, we are only looking at net profit realized from the international transaction. And when we look at comparables, suppose I am rendering software services, I find out a company which is into software services, say C Limited, but it is also doing call center activity. Can I take that as a comparable? If I take that as a comparable, should I adopt entity level figures of software plus call center, or I will have to draw the software segment? I'll have to look at the software segment, pretty logical. But the question is whether the comparable has given the data in its ES 17. because I will not be able to draw it myself. How do I know what is the profit in a software segment and what is the profit in a call center segment? So I will have to go back to financial statements of that company, look at its AS17 segment reporting and see whether it is available, whether that data is available to me. And if it is available, then I will take that software segment as a comparable. Otherwise, I will have to reject that company as a comparable. Take further example. Suppose that comparable C Limited, 99% is software, only 1% is call center. Can I then take a comparable? Is the difference material enough to affect profit, cost and revenue, price? Is this 1% sale in third party of call center, is it so relevant that it will make it as an uncomparable? Possibly no, because this is a small deviation. So it is not just 1%, it could be 4%, 5%, 10%. Generally we take a threshold of 75%. That at least 75% activity should be similar. The logic is that if predominant activity is same, the other activity which is 10% or 15%, the influence of that on net profit may not be very high. If the influence on that on net profit is very high, then I have to exclude it. But influence of that on net profit is not very high, because what we discussed in rule 10b3, are there material difference which affects cost, profit, etc. So if there are material difference, then I have to ask a question, okay, is this a 10% call center sales, is this material to affect the net profit of that company C Limited? If answer is yes, I have to exclude it. If answer is no, then I can adopt as a comparable. And given that the quantum of third party sales or call center sales may be less, we can possibly adopt it as a comparable. That may not be much of a difficulty. So there is another aspect that we have to take care in TNMM, the segmental, either in the case of the assessee for whom you are doing the study or a certificate, or in case of third parties which we are taking as a comparable from the databases, whether they are having a similar activity, and if they are having multiple diverse activity, can we draw a segmental for that multiple diverse activity on the basis of AS17. If AS17 data is available, it can easily be used. Then coming to various other aspects of computing net margin, another aspects are, like for example, should I include, I have already explained we need to exclude non-operating items like loss on sale of assets, items which have nothing to do with business, extraordinary items, abnormal items. Couple of items have been a huge amount of dispute. One is foreign exchange gain or loss. Whether I should consider that as a part of profit or cost while doing a net margin computation under TNMM. The department originally was always taking a view that foreign exchange gain or loss has nothing to do with international transactions, so you should exclude that as a part of computation. Even if you look at safe harbor rules, they very clearly say that foreign exchange gain or loss should not be considered for calculating the net margin under TNMM. But there are many judicial decisions which have accepted the view that foreign exchange gain or loss is because if the assessee sale is to related party, international transaction, which is in foreign currency, naturally any deficit or excess that are realized from that transaction is directly linked to that international transaction, and it should be taken as a part of operating activity or operating margin. Only thing you have to keep it in mind here is there could be foreign exchange gain or loss arising out of capital transaction, loan transaction, which you need to naturally exclude while calculating the operating margin. Another aspect that is very relevant in TNMM, which generally gets ignored, is the accounting difference. The net profit today, what we have in the financial statements, may get impacted by different depreciation policy. So I may have your assessee may be charging very high rate of depreciation. The comparable may be charging very low rate of depreciation. In last year, there was an issue in telecom industry. The Jio showed a break even. The opponents made a claim that Jio's depreciation policy is such that it is showing more profit. So these kind of differences may be there, which you need to look at your depreciation policy, or you need to look at the auditor's comments in the audit report, which may give you some guidance that are there any major issues in the financial statement of a comparable. Are there any indication that these financial statements that we are making a basis of comparison are vitiated because of XYZ reason, are tainted because of XYZ reason? If the auditor has made a statement that profit is not proper, I am not confident of the profit, and he has made a disclaimer in his audit report, then naturally we need to be aware that we cannot take that company as a comparable. Another important aspect that has arisen in last 2 years is Ind AS. The way profit is calculated in Ind AS, way the accounts are stated in Ind AS is completely different from the Indian GAAP. So if the assessee is Indian GAAP and the comparable is in Ind AS, either you need to remove the impact of those Ind AS entries. They will generally give a schedule in terms of reconciliation of what are the entries that are coming because of Ind AS. You need to remove that impact of Ind AS. If you are not able to remove that, I would feel that those companies cannot be taken as a comparable, because the financial profit that comes in Ind AS financials is completely different than the profit that gets reflected in the normal accounting standards. So this is another aspect that we need to take care. So these accounting differences could be depreciation policy, writing off ESOPs, or employee benefits. There could be these differences sometimes which you can get, and there is a comment on this by the auditors in their financial statements that need to be taken into account while drawing the while looking at the comparison. Then we come to the concept of adjustment and tested party. So as I said, we have step 1, how to calculate the net profit. Step 2, we said net profit of the comparables. The calculation of net profit of the assessee and of the comparable is on the same lines. The step 3, that is a clause 3 in rule 10b(1)(e) is adjustment. As I explained already, you need to look at the adjustment if there are material differences which have impact on price, etc. Now, how do you make this adjustment? 1. Second, whom to make an adjustment? If you go back here, okay, first let me explain you what is the concept of tested party. Okay, then we can go into the adjustment. Now, in the transfer pricing, tested party has a name suggests is whom are you testing? Whose profit margin you are testing? If I am looking at TNMM, whose profit margin I am testing? If I am looking at price, whose price I am testing? Okay. Take an example of a cup. I do a sale to my associated. Suppose I am selling this laptop to my associated enterprise at X dollars, at say $1,000. Now, I can test this transaction in 2 ways. 1, I can test my sale price, say that my $1,000 is at arm's length or not, or I can test the purchase price of my associated enterprise. For example, say associated enterprise purchases this similar laptop from third parties at $900 or say $950, and my sale price is $1,000. So from India's perspective, we'll look at from the India's perspective. Let's say my associated enterprise is in US. So we'll look at from the India's perspective. I will be able to argue that I have sold this laptop with same configuration, same make to my associated enterprise at $1,000, but my associated enterprise has purchased this similar model with same configurations at $950 from third parties. So that is another way of testing it. So here, who is the tested party? My foreign E is the tested party. If I test my sale price, suppose I am able to say that okay, I have sold to my foreign E and also I have sold to third parties at same $1,000, then I am the tested party. Okay, so there could be either of the enterprise which is a tested party. Okay, that is the concept of tested party. Generally, the thumb rule for taking a tested party is if one, for whose case reliable data is available, and second, who is the least complex. If there are 2 parties, one is simple entity and one is more complex, you will always take the simple entity as a tested party. I will give an example. Suppose there is an Indian company which renders software development services to third parties, to associated enterprise. And associated enterprise does the marketing, does the various other activities, gets the funding for the operations and everything. Now if Indian entity is cost plus only doing software services and foreign enterprise does all the other functions, who is the least complex? Indian entity, because its only function is do software, send it, bill it on cost plus. Right? So it is easier to test the profit of the Indian entity. So that's why we say you take one which is least complex, or second, the reliable data should be available. When we take foreign parties as tested party, the challenge is the availability of reliable data. Suppose if I take US company as the tested party, I need to get comparables in the US geography or at least in the North American geography to get as a tested party, to do the arm's length benchmarking. That becomes pretty challenging. But the main point that comes here is whether I can at all take foreign AE as a tested party under TNMM. So if you see the first clause again here, we come back to rule 10b(1)(e) clause 1. It says net profit realized by the enterprise from the international transaction. Now here when the word enterprise is used, does it mean only Indian enterprise or it could be foreign enterprise also? Yeah, can it be foreign enterprise also? The plain reading of the clause does not provide that you should take only Indian enterprise as a tested party. In my opinion, that is a proper interpretation also, because here there is no restriction. There are certain judicial decisions which have taken a view that you cannot take foreign enterprise as a tested party. No doubt the matters will have to travel to higher forums, to High Court and Supreme Court, and a decision will have to be taken. But we need to understand that transfer pricing is not just law, it is an economics which comes into here. And ultimately I can justify from either side of a transaction. And when I am justifying from either side of a transaction, it should, from an economic point of view, should be accepted. So also the plain reading says net profit realized by the enterprise. So a foreign enterprise could have been taken as a tested party. There should not be much of a difficulty if we interpret in a literal sense of that. Now let's come back here. Okay. So I have already explained why adjustment should be enabled. Okay, we need to go back to the clause. Okay, now let's read clause 3 again. The question that arises is, when I identify a difference, can I adjust the net profit of the associate itself or the tested party, or should I always adjust the net margin of the comparables? I hope you got the point, right? So if I take this in a cup language, my transaction is FOB, the comparable is CIF. Should I always make that CIF as FOB, or can I make FOB as CIF? Right? Now apply that logic to TNMM. Now just look at rule 3. Suppose I have to do an adjustment. Let's say take a case of labor unrest. If there is a labor unrest, suppose there is a car manufacturing company which is buying transmission engines from related party, converting it into a car, doing the functions and selling to third parties. Right? Now this company is having a labor unrest. We have identified 3 comparables A, B, C which do not have labor unrest. Right? Now there is a difference, right? Which difference will naturally have a impact on the margins? Because of labor unrest, I was not able to manufacture, my sales were less, and therefore my fixed cost absorption is less. Now, should I make an adjustment while calculating the margin of the tested party, in our example say Z, or should I adjust the margins of A, B, C and assume they also have a labor unrest? Right? Look at rule 3 which talks of adjustment. The net margin referred in subclause 2. Now what is subclause 2? Is the net margin earned by comparables. It is the net margin earned by comparables. So net profit realized referred in subclause 2 arising in comparable uncontrolled transaction is adjusted to take into account differences. Let's stop here. So what does the rule says? It only says you can make an adjustment to comparables. Now cannot I make an adjustment to my own margin and do it? That is the question. Should an adjustment be always made to comparable, or adjustment can be made to the tested party itself or the enterprise or associate itself? This is important because making an adjustment to tested party or the associate is always easy, whereas making an adjustment to comparables is more difficult naturally. If we take just our example of labor unrest, let's say there is 45 days of labor unrest in company Z, which is our associate. Now, is it not easy to remove the fixed cost related to 45 days of my assessee and recompute the margin of Z Limited, or making an assumption that 45 days of labor unrest would have also been in case of comparable, then I have to assume what would have been sales related to that period, what would have been the raw material consumption for that period, and do all that, which becomes naturally very difficult. Because of this clause 3, if you see today, if you ask any adjustment, the transfer pricing officer will pass an order. Under sub clause 3, only adjustment can be made to comparable. You have made an adjustment to the tested party, your adjustment is rejected. This is a simple order they will pass. But they don't understand the economics behind this, or the rule or the law behind this. As we already saw, Rule 10b(3), what it says, is there a difference? If there is a difference, adjust it. If you cannot adjust, remove the comparable. Now I am having a labor unrest, comparables are not having a labor unrest. Is this a difference? Yes. Can you make an adjustment? If you cannot make adjustment, that means there is no comparable to me. Or I have to find out a comparable in India which also had similar labor unrest, which is highly impossible task. So, reading the rule in literal sense, today in most of the cases adjustments get rejected, saying that there is a difference, we agree, but we cannot make an adjustment to the comparable. We cannot make an adjustment to the tested party. Please make this adjustment to the comparables. Sorry. And that becomes challenging, because naturally to make an adjustment to comparable, we need to have more amount of data. Then my data will naturally be available with me, but when it comes to comparable, getting this data and making so many assumptions and making that adjustment to the comparables is practically very difficult. Let's come back to this rule. Let's read clause 1 again. It says net profit margin realized by the enterprise from an international transaction. Let's stop here. So it should be a net margin realized from an international transaction. If my net margin gets affected by external factors like labor unrest in our example, is it a net margin realized from international transaction? Or it is a net margin which is influenced by external factors, not just international transactions, right? So the proper reading would be that if you have a difference, the difference which is arising, say, because of various factors, it could be labor unrest, it could be underutilization of capacity, it could be advances which are received from comparable, what we call as working capital adjustment. So if I am having these differences from various cases, then should I make an adjustment to the comparable or should I make an adjustment to the tested party? The question which we need to answer here is if my financial statement's net margin is influenced by X number of factors, which are capacity underutilization, labor unrest, or working capital differences, then is it a net margin realized from international transaction? The rule today expects, the subclause 1 today expects us that the margin should be only from international transaction. We are not looking for other margins. We are looking at pure margin that is earned from the international transaction. And therefore, a view should be taken in the assessment proceedings that if an adjustment is made to the tested party, then that adjustment will always come under clause 1. So adjustment to the comparables will come under clause 3 and adjustment to the tested party will come under clause 1. This is the ground which we need to take in case you are handling any transfer pricing assessments. This is supported by various decisions. No doubt there are too many contrary decisions also. So if you see these decisions of Haworth or Petro-Iodide, they have taken a view that you can make adjustment only to comparables and you cannot make adjustment to the tested party. But you can refer to the decision of Aristothermo in case of Pune Tribunal. This is a very important decision which discusses this interplay between clause 1, that is rule 10BE1 and rule 10BE3. And what do you mean by net profit realized in rule 10BE1 and what do you mean by adjustment in rule clauses 3. So they say when we are talking of an abnormal items like this, in those cases, that case the adjustment was for underutilization of capacity, and there was very high level of underutilization of capacity in case of assessee, and whereas the comparables were having very high level of utilization. So say for example assessee is at 20% and comparables are 18%, naturally the fixed cost absorption level is very different. and you need to make an adjustment for fixed cost and remove that fixed cost from the assessee to say that okay, we'll bring you at par and make an adjustment for that. Now that was argued in this particular case as to Thermo India, and the Pune tribunal took a view that in these adjustments which are there, we can be read into clause 10b(1)(e)(1) itself, rule 10b(1) clause E subclause 1 itself, and you can make an adjustment to the tested party applying the net profit realized from international transaction principle itself. So this is one aspect that you should keep it in mind while taking up any of the transfer pricing issues. Any questions? This aspect is clear? Look into certain other aspects what arise in TNMM. So we have seen the methodology of computation. Another important aspect that comes up is the aggregation of transactions. That means if I have multiple transactions, how will I apply TNMM? If I have multiple segments, how will I apply TNMM? So this is one important aspect which we have to take into case. Many times you only have an expenditure transaction, right? You really don't have, when you have an expenditure transaction, suppose I do purchases from associated enterprise. Now the rule says net profit realized from international transaction. Can you compute a net profit from an expenditure transaction? No. The net profit is naturally only from sales minus cost. So it's a financial statement from which we compute the net profit. But the rule says net profit realized from the international transaction. So when I have only purchase transaction, how will I do the benchmarking? Whether it is covered under TNMM, whether I can do it under TNMM is an issue that needs to be seen. That is one aspect of it. Second aspect is when you have multiple transactions, multiple segments, can TNMM be applied and how the TNMM will be applied? Couple of important aspects here we need to see. First, 10A, capital rule 10A, clause D says transaction to include a number of closely linked transaction. Transaction includes number of closely linked transaction. Very interesting terminology used. We in the TP language we clauses closely linked transactions. The last limb of that particular clause. What do you mean by closely linked transaction? That means when I am doing a benchmarking, if you go back here to the rules, net margin realized from an international transaction. So it's uses the word an international transaction. So does it mean only single transaction is to be taken? An international transaction. Now come to clause 2. It says net profit realized by an enterprise unrelated from a comparable uncontrolled transaction or number of such transactions. So one transaction or number of such transaction. One transaction or number of such transaction. So what is this? How do you analyze or look at this particular thing? Suppose if you go by the first limb, enterprise from an international transaction, profit realized from international transaction, does it mean, suppose I have rendered services throughout the year for software services, should I test each services independently or can I aggregate all the 12 services and do a net profit margin? Should I do a month on month net profit margin or should I do a net profit margin of 12 months? So though the phrase used here is an international transaction, when we go to the rule, it says transaction to include number of closely linked transaction. Suppose I render software services throughout 12 months. Okay. Now is that closely linked? Suppose all the services are under same master service agreement. Is it linked? Are the services linked because it's only one service agreement? Possibly yes, because all the services are under same agreement. Let's take different examples. Suppose I have two segments, manufacturing segment and trading segment. Can I say activities or international transaction in manufacturing segments and international transaction in trading segment are linked, or should I benchmark these two segments separately? Should I benchmark separately, or will I say that I can benchmark at entity level? Separate? That is a natural logical reasoning of this. Now let's expand this further. That suppose there is a connection between manufacturing and trading segment. Suppose let's take a car manufacturer. He does manufacturing of cars, sells it through his dealer network. But he has to do a post-sale services. That means the car needs to be served in the warranty period. Post that also post-sale service parts needs to be there. Now service parts have to be sold, right? Now when a service part has to be sold, that time he does a trading activity. He buys the parts and gives it to dealers. Now now I say that trading activity is linked to the manufacturing activity? Is there a connection between these two? Take a much easier example to understand. Printer and cartridge. Razor and blade. Most of the companies sell printer at a loss because they know that they will make profit in cartridge. You sell the razor at a loss because once he has bought that printer, naturally he will come back to you for a cartridge. When I sell a razor, naturally he will come back for me a blade. When he takes a car, I may sell it at low margin and naturally he will come back to me for a spare part service and other services. In fact, in case of India itself, there is a huge penalty levied on all the car manufacturing companies because the spare parts sale profits are much higher and there is a manipulation in pricing in that. And hundreds of crores of penalty has been levied, the matter is still pending. Right? So now the question is there a link? Or when there is a link, how do you do a benchmarking? We call this as a bundle transaction. That means they are part of one bundle. And you cannot look at these transactions separately because they are one and the same. So transaction include closely linked transaction would mean that whenever there are bundle transactions which are similar, which are linked, which are interrelated, that time the transfer pricing method should always be applied bundling this transaction and not segregating this transaction. If the transactions are independent, which are not interdependent on each other in terms of sales and other aspects, in those cases the benchmarking should be done separately. But in cases where they are bundled transactions, there is an interlinkage between them, and rendering of in one case is somewhere there is a linkage between them, then they should be linked together and the bundling should be done and benchmarking should be done together. This is the case of Bangalore Terminal Indicators, case of Toyota Motor Corporation. Toyota Kirloskar Motors TKM. In that case, there is a manufacturing activity and a trading activity. And trading activity is because of manufacturing activity. Trading is mainly because of trading of spares. So, and also all the comparables what were taken in that particular case also were engaged in manufacturing as well as trading because they also had to do trading of parts because of after sales services. The Bangalore Tribunal said yes, these are closely linked transactions. It is at par with the comparables because comparables are also doing the same activity, and therefore bundling of trading and manufacturing segment is accepted and both can be benchmarked together. But in cases where they are independent transactions, in those cases bundling of transaction will not be permitted. So when you have a case at hand, you need to see what are different segments, are they independent segment, is there an interlinkage, interrelation, interdependency between these segments? If yes, then possibly you may have to bundle it. If no, then you have to do independent benchmarking. So every case you need to see what are different kinds of international transaction, is there a linkage between them? If no, if yes, you bundle it under TNMM. If no, then you do an independent analysis of this. You cannot bundle all transactions. Suppose there is a loan transaction and purchase of raw material. I have paid interest on loan. Can I bundle it? No, I cannot bundle it because you will have to be seen it separately. The transaction will have to be seen it separately. But so like this, you will have to analyze in each case and do it. Similar issues arise, suppose in case of royalty. Now I have paid royalty, I have got license to manufacture, and based on that license to manufacture, I am manufacturing and selling it. So I also purchase raw material for manufacturing activity, components, parts for manufacturing activity, and I sell to third parties in India. Now can I bundle the royalty transaction and the purchase of raw material and then look at combined net profit from that, and can make an assumption, what we have written here, that if the net profit is at arm's length, that means royalty and purchase transaction both are at arm's length. Can you make that statement under TNMM? Got my question right? So I have purchase of raw material, I have royalty payment for a license to manufacture. That is directly linked to my manufacturing activity. That means if I had not bought this license, I would not be doing manufacturing itself, right? So there is a linkage between my royalty and my purchase of raw material. Based on this, I do a sales and sell to third parties. Now, can I then assume that because there is a net profit, suppose I have made a net profit margin of 5%, I found out the comparables which are at 4%, therefore my net margin is higher. So can you then say that because my net margin is higher, therefore both my transactions of royalty payment as well as purchase of raw material should be considered as arm's length? Can we make that statement? Or you'll have to make it separate. The question again is, are royalty payment and purchase of components interlinked? Are they bundled transaction, or what we say closely linked transaction? That is the first question that we need to ask. If we answer this question that yes, there is a linkage between both of them, the linkage is that without royalty, I would never be in existence and I would never purchase a raw material. These are some of the aspects. There are both for and against decision on all these matters. Do not go by that. You look at the economic sense of view, economic point. TP is more economics than law. That is there a linkage and interdependency between these transactions? If the answer is yes, then you have to bundle it and you have to look at that if my net profit is at arm's length, then it is to be considered. But if it is totally different transactions, a purchase of component and payment for a software license which has no connection, then you cannot apply this principle. Couple of more points on this. The challenge which arises is, in the example which I gave, parts and components versus royalty. Suppose I have paid 6% royalty. Okay, after paying 6% royalty, I made 5% net margin. Comparable is 4.5. The question is, if I had an independent benchmark, if I have independently looked at royalty, suppose I find out that royalty should have been paid at 3% only, not 6%. That means after paying more royalty also, I made more profit because I may have more efficiency in other aspects. I may be more efficient in manufacturing, I may have a better dealer network or various other parameters, right? So whether 92.3, which says that if you do a transaction and if you apply transfer pricing for that transaction, which results in increase of loss or decrease of profit, then TP is not applicable. So that means if I apply the arm's length principle, suppose I pay 1% royalty and I apply arm's length principle, I should have actually paid 3% royalty. Then you cannot say I will increase my expense by 2%. That is not possible. It is one way. Transfer pricing is one way. Only revenue favoring adjustment can be done. So 92.3 comes into between, and that is where the real challenge lies. But that is where the real challenge lies, and if the department is able to argue on this 92.3 point, which they are naturally doing it, then there could be some challenges to say this bundling should not be done. We will have to fall back on this definition of transaction, which says transaction includes closely linked transaction, and once the transaction is a closely linked transaction, then they are not two different transactions, they are part and parcel of same transaction. And in a business, like I gave an example of printer cartridge, razor blade models, where one transaction supports the other transaction, and both transactions, one I make a profit, one I make a loss. The whole idea is ultimately at the entity level, from a business perspective, I should have made a profit. That is what one should look at. This aggregation will also throw challenges in secondary adjustment. Suppose I have made 5% net profit, I have aggregated royalty and components, but the comparables have made 10% profit, and in a 100 crore transaction, the 5 crore is adjustment. Let's assume 5 crore is an adjustment. Now the question is this 5 crores towards material and component? Is it 5 crores only towards royalty, only towards material and component, or it is proportionately to both? Because when we come to secondary adjustment, the secondary adjustment provision which were inserted 2 years back, section 92CE says that if a primary transfer pricing adjustment is made and if the assessee accepts that transfer pricing adjustment, in our example 5 crores, he need to get that 5 crores from the related parties back to India. If he doesn't get that 5 crores to India, then 5 crores is treated as a deemed advance to related party. On that 5 crores, interest at a particular rate as prescribed in the rule will be charged in perpetuity till you get that 5 crores back to India. So if you don't get 5 crores back to India, then we charge you the interest. Now the question is, from whom should I get 5 crores? From the party from whom I purchase material or a component, or the party for whom I am paying the royalty? From whom should I get 5 crores? Should I get proportionate? should I get from one party or whom? There is no answer to this question, but this is how you bear it. If you get 5 crores only from one, the officer will say, I will not accept it, you should have got from other also. So there will be some challenges because of bundling of transaction in the secondary adjustment, assuming that the conditions of secondary adjustment are satisfied. That is just a follow-up of a different provision, but otherwise the principles on aggregation what we have discussed should be applied at a practical level. Next aspect or the last aspect that we will discuss is the when you do a TP adjustment, should we consider how do you do a TP adjustment, right? In the sense, should you look at both AE transactions and non-AE transaction? In a business, you will have transaction with both related parties and non-related parties. As we discussed in the beginning, the segmental have to be drawn, right? Now, what is happening at many a times? Suppose I am rendering software development services. I have 20 crores of sales, 15 crores to related party, 5 crores to third parties. This 5 crores transaction is with the domestic party, let's assume. So 20 crores is the transaction. Okay. Many times associates do not maintain segmental. Being less than 50 crore threshold AS 17 is also not applicable. Therefore, I do not give audited segmental as a part of my financial statements. And the officer, when he does adjustment, he does adjustment for whole of 20 crores instead of doing only for 15 crores. In fact, one case I had, which is a very peculiar case. The related party transaction were 450 crores. The adjustment was made at entity level, and this 450 crores was an expense item transaction. That was a payment was made to related party for purchase of certain commodities. The adjustment was made is 1050 crores because of entity level adjustment, and you apply on the total sales was some 6000 crores. Just took the difference of profit margin and applied on the entire 6000 crores. That means, applying TPO's logic, I will purchase the goods from my related party at free, and over and above he will pay me. Right? This is what happens when the adjustment is done at the entity level. In many times the other way around also. When I am doing the sales, they are making an adjustment at the entity level, which results in an abnormal high item of adjustment. So, when we deal with this at a assessment level or various level, couple of things we need to keep it in mind. First is audited segmental, even if not part of your financial statements, because I may not be mandated to maintain AS 17. If there is a AE and non-AE transactions, first we look at the revenue transaction. I'll come to expense transactions later. If I'm rendering services to AE, rendering services to non-AE, always make it a point to have segmental financial statements as a part of your TP study, and along with an appropriate basis. The various decisions of court, 3i Infotech and other have taken a view that you need not have audited financial statements, but you need to have audited segmental statements. Audited segmental not required, but you need to have segmental financials, not necessarily audited. Though the tax authorities take a view that they should be audited, otherwise I will not accept this. That's a different issue. Okay. Though as a part of AS 17, I may not have maintained a segmental financial statements, but when you have both AE and non-AE transaction, make it a point that the client maintains proper segmental financial statements, that in case the assessment comes up, it will be necessary. That is point number one. And keep this. The allocation will always, the direct cost have to be naturally allocated directly to the relevant segments. So there has to be some timesheets maintained, or if it's a manufacturing process, you need to find out what is the way you can identify the costs related to the appropriate segment. In case of services, the timesheet and other things should be maintained, or at least the employees should be tagged to particular segment so that the cost can be allocated to that segment. Apply the normal costing principles that we apply and capture the cost in a particular segment. Naturally, indirect costs will be allocated based on an appropriate ratio, which would be employee cost, employee floor area, or various other parameters. So these aspects should be taken. The Bangalore Travel again in various decisions like Honeywell, 3i Infotech has very clearly, and 3D Networks has very clearly taken a view that one, audited segmental is not required. Second, if the segmental is given, and only allocation that can be done is of indirect cost. Direct cost, the EO cannot just allocate it wherever he wants. He cannot disturb the direct tax allocation unless he finds a mistake in assessee's data or documentation which has been given. Once the assessee has supported his direct cost allocation, that cannot be disturbed by the tax officer. So these are two important points that you should take care, that I draw a proper segmental when I am rendering services to A and I am rendering services to non-A. So proper segmental is drawn and proper bifurcation is made between the segments. The transfer pricing methodology should only be applied to each segment. If we ourselves apply to entity level financials, in all probability we will land in trouble at the time of assessment if the matter gets picked up for the assessment. Second part of it, which is more interesting, is if I have an expense transaction. Suppose I have, let's take a simple micro level example of 100 rupees. 40 rupees is purchases from related party, 60 rupees is purchases from non-related party. Okay. Now assuming that TNMM adjustment is 5 crore rupees or 5 rupees. Can you say I will adjust to only by A transaction of 60, we will take at 60 and 40 to 3 crore rupees or 3 rupees, or should the adjustment be for entire 5 crore rupees? Can I do a proportionate principle? The idea here is both A transaction and non-A transaction in an equal proportion contribute to earning of net profit. Okay? Or the assumption that which the department generally makes is that whatever is the deficit is only because of that 60 rupees. Instead of purchasing at 55, you have purchased at 60. Therefore, there is a deficit of 5 crore rupees in our example here. Right? I should have purchased at 55, but I purchased at 60. Therefore, there is a deficit of 5 rupees. Can I make that assumption? And can the department today make that assumption and they make adjustment of 5 crores at an entity level taking both A cost and non-A cost? There are various tribunal decision and various decision. In fact, there was a case in Bangalore itself, Hyundai's case. The AO had taken only AE cost and the DRP made an enhancement by taking total cost. So the addition increased like anything, because if I have 60 crores, 60% purchases from AE and 100 is the total purchases, suddenly the addition if I applied on the total operating cost will be much higher. And if I apply the addition or the differential margin ratio only on the AE cost, the addition will be much lesser, right? So this has been one of the issues. We have various favorable decisions like LG Electronics of tribunal and various other decisions. This is another aspect which should be taken care. We have not, most of the decisions are in favor of the assessee. There is hardly any decision against the assessee, because fundamentally the transfer pricing is only for related parties, associated enterprise. How can you go and make an adjustment for non-associated enterprise? So this is another important aspects in TNMM, that you draw a proper segmental, only look at the A transactions and make adjustment with respect to A transactions. So with this I have covered some of the important or interesting issues in TNMM. If you have any questions, you can take the questions. So if there are no questions, then we can proceed. Thank you everyone for your patient hearing. I thank the Bangalore branch for giving me this opportunity to share my views on transfer pricing, and thank you everyone for patient hearing. Thanks.
Friends, we had a detailed analysis of transactional net margin method, and the speaker made an excellent presentation. I am sure all of you enriched from this session. Please thank the speaker for his valuable time and knowledge sharing with us. Thank him. Round of applause. May I request R.M. Kamath sir to come forward and present a gift voucher to the speaker as a token of appreciation and gratitude. Please thank him for a round of applause. Thank you. So, thank you very much for your active participation, and keep coming to the Wednesday Study Circle meet. Thank you very much. See you next week.